Hello there and welcome to the Hashpower Academy, your place to learn anything to do with Bitcoin. The topic of today's video is what I like to call the Bitcoin accumulation flywheel, leveraging the debt money system of the past to build the energy money system of the future. The combination of Bitcoin lending in this box with Bitcoin mining in this box. And the five key components of this are your Bitcoin as collateral, credit, that you essentially access the value of your Bitcoin. And what you do with that, just don't forget that there is interest accruing on such a thing. So if you used said credit to buy mining hardware and Bitcoin mine, or even use the credit as well to pay electrical bills, so it would increase at an ever increasing amount, both electricity and interest costs. And what are you weighing it against? This Bitcoin yield and the value of Bitcoin going up in terms of dollars over time. And when you combine it all together, you've got risks and rewards of using credit and risks and rewards of using Bitcoin mining. There's incredible rewards on both sides. We'll dive into that. And there is risks on both sides. But interestingly, this setup, both of these components naturally de-risk each other. And we'll go into that as well. Other pieces of the video, I'll also delve into what if Bitcoin mining could be used as collateral, something that I'm developing into the future, where you could essentially deploy your hash rate as collateral for lending, just like Bitcoin. Think of all of the financial benefits of Bitcoin, but introduce Bitcoin mining with Bitcoin yield. There's some spicy stuff in there, and we'll dive into that somewhere in the video. And there's all the other different components, such as the tax advantages of buying a physical good like Bitcoin mining hardware, if you have that in a structure such as an LLC, all those sorts of things. And the most important aspect of this is we will be diving into all of the risks before we go into the rewards, because this is not financial advice. This is educational purposes only, of course. And let's dive in. So, number one, your one Bitcoin, and we're going to use $100,000 as its example, because remember, with credit and the debt money system, the unit of account is dollars for here. So if you've got, you say, 14% interest, which is, what should I say, standard for Bitcoin lending, and they typically let you access the value of, say, 50% of your Bitcoin. So if you've got your one Bitcoin deposited in a centralized lending platform, or a decentralized one that there's a couple being developed at the moment actually, and you put your $100,000 of value, they'll let you borrow $50,000, 50%. 50% loan to value, the loan and the value. And the third piece of this is what you do with that credit. If you buy Bitcoin mining hardware, that is something that's producing, say, 30 to 60% a year in Bitcoin. Now, if the price of Bitcoin goes up, this number goes up. If you buy the machines in bulk by jumping this all up by 10x, 20x, going into the millions, you're going to get a cheaper price per unit. You're going to get much higher yield because your dollars buy more hash rate, so you're earning more Bitcoin from the network. And so there's all these different numbers and pieces. So I'm going to really try and keep it relatively slow, just to make sure all the pieces are understandable. And then the most important piece about this and the risk side of the credit is the value of your collateral. If it drops in its dollar term with a dollar unit of account here, if it got to about $60,000 with your $50,000 of debt, that's when you're in danger zone, really. And if it gets too close to the amount of debt that you owe, they will forcibly sell the Bitcoin to pay off that loan. So how do you avoid it? You reduce the amount of credit versus increasing the amount of collateral. And how do you do that? You utilize the credit into Bitcoin mining to produce more Bitcoin and de-risk the whole thing by starting with one Bitcoin as the quantity of your collateral and continually increase that quantity through Bitcoin mining. And this goes back to the idea of good debt versus bad debt. Bad debt is when you spend on your credit card at 10, 20, 30% to go on holiday. It sounds lovely. You're going to remember it forever. But that price tag is now going to accrue interest. There's nothing behind that that's now generating you some income to pay that back. And that's where the good debt conversation comes in, whilst considering the risks to rewards of what you use on it. If you are accruing interest at 14%, you need to be paying that back somehow. That's where the Bitcoin mining piece steps in. If you notice that the Bitcoin mining is of a multiplier higher in a relative period of time of stacking more Bitcoin, say, if you purchase mining machines that for every $1 of electrical expense, you're producing $3 of Bitcoin, that would be a production floor of 33%, because you want to get the most efficient miners to get that ratio the highest. The inefficient machines, you're going to have a lower energy to electrical cost versus revenue output. The ratio will be smaller. You want the highest ratio possible. And with the latest generation machines coming out, you'll probably get to the 33 down to the 25% production cost of the price. You want to get the loan to value percentage lower than the natural production cost of your Bitcoin mining setup. And so understanding that percentage on both sides is that clear piece of information. Because if the price of your Bitcoin drops close to your loan to value percent, you're in danger zone. So if you're continually stacking Bitcoin, say $4 of Bitcoin are adding to collateral to every $1 of electrical expense plus the interest, you've got to factor all these pieces in, you're making the collateral grow quicker in quantity than the interest is compounding. And what that does is lower your loan to value. So the mining is de-risking the credit side. And the credit side, interestingly, allows you to spend and buy mining hardware without selling Bitcoin in the first place. Because remember this, mining, the reward side of mining, is an opportunity to accumulate a greater quantity of Bitcoin over time than the Bitcoin you could have just purchased in the first place. The $50,000 being deployed, well, you're either selling Bitcoin or with this, you're accessing credit. So what it does is this. I mentioned that credit is on a dollar-based unit of account. With Bitcoin mining, you're on a Bitcoin unit of account seeking a Bitcoin return. Because if you didn't use credit at all and you just spent $50,000 or half a Bitcoin on mining machines, you spent half a Bitcoin on the miners. You're trying to make those miners produce more than half a Bitcoin in their lifespan of operation. And so what you have there is this Bitcoin ROI that you're trying to chase. And the dollar value is a bit different. So interestingly, if you're not selling the Bitcoin in the first place because you've used credit, and yes, twice as much, you're not chasing a Bitcoin ROI, you're chasing the dollar ROI from mining plus the interest. So you can chase and achieve it much quicker relative to a 4 to 5 year lifespan of machines. But you've also got the risk side of those machines are physical goods, they can break, make sure they're with a good provider that can have good access to repairs. Always ask the mining host, if my machine breaks for X manner of reasons, what is the repair time? That's the most important because you've got this opportunity cost of diminishing returns. The halving comes every 4 years and the difficulty adjustment is going up. So with mining, you're naturally earning a smaller and smaller quantity of Bitcoin over time, but its dollar value is higher. And so those are all the different moving parts of this. But the natural effect overall is you've got this waterfall of the pristine collateral of the entire world, Bitcoin, accessing its value to leverage it naturally to buy mining hardware, a tax advantage physical good if you put it in an LLC or some other thing. Again, I'm not a tax advisor or anything else. Go and seek all such advice yourselves. You're producing Bitcoin, get the most efficient machines and cycle said Bitcoin into the collateral to de-risk the credit side. Now, what are the outcomes of this? What are you trying to achieve here? Well, if you stack your half Bitcoin from the mining over said amount of years, you've got 1.5 Bitcoin. All you need is to get the loan to value lower than 33%. So that when you close that loan, you're selling effectively half of a Bitcoin. So you've still got 1 Bitcoin, plus you've got the miners still. That's the point to reach where when you close that percentage, when you close the loan, you could also sell the machines if they're liquid. We'll get onto that in a second. You want the loan to value to drop to a point that when you close the loan, you're closing it with still more than one whole Bitcoin plus the machines that you purchased with the credit in the first place. So this overall process started with one Bitcoin, and you closed the loan with more than a Bitcoin plus the mining hardware, or you sold the miners and you've finished up with 1.2345 Bitcoin. It's also dependent on the price as well. But the interesting thing of this is naturally, you want the interest from the mining side, the yield, to be of a greater multiplier than the interest, because Bitcoin trades sideways 90% of the time. I think there's like 10 to 20 days where it has its stupidly high green moon candles. So if you're trading Bitcoin and you miss out on those massive upsides, you're better just holding. And on the mining side, obviously, every time it shoots up, you're capturing that dollar premium, or in terms of loan to value credit side, you're stacking that dollar value of Bitcoin, because a lot of lending products, the more collateral you have relative to the amount of debt that you have, the lower your loan to value, they lower the interest rate as well. So you've got this natural de-risking by increasing the collateral, and de-risking, reducing the interest rate, so the rate of compound interest is lower as well. We're in a world where if you've got stupid amounts of dollars, you get the tiniest insignificant interest rate. And if you've got no money, you get the highest interest rate. Not really meritocracy, if I scale economy in a sense, but not really good. Yeah, there's lots to this, but the overall gist is you're able to get the rewards of credit to buy miners, and the reward of having a dollar-based unit of account for mining, which is much quicker to achieve than chasing the Bitcoin return on investment unit of account setup. And I'll get to the bit that I'm developing, which is, if hash rate was made liquid and fungible, you could loan against it. And so what if, instead of extracting $50,000 from this entity to buy physical good, that you could deploy it as hash rate as an asset, and instead of stacking the Bitcoin over time to get your extra half Bitcoin to lower the loan to value to 33%, what if you could immediately access the $50,000 of credit, buy hash rate as a financial instrument, and deploy the $50,000 of hash rate, which produces the Bitcoin? And you immediately jump from the 50% LTV in the credit sense straight down to 33% loan to value. And Bitcoin mining hardware is less volatile, because you're also trying to anticipate the downside risk of your collateral plus this new form of collateral against credit. Because here's the thing, the financial sector don't look so much in the mining and energy sector, because they're so obsessed with Bitcoin as the financial instrument. And the energy sector are obsessed with energy, always needing finance. So I'm sort of visualizing this way of combining these two and condensing them down into this sort of natural feedback loop in the same structure. And you're essentially just producing more Bitcoin and cycling that immediately into collateral here. It gets very interesting and very powerful when you combine the issuance power of the network as a financial instrument in of itself. If you're interested in that sort of thing, I have a website, terahash.finance. That's my project of many years in development, and it's where all this sort of educational material of the Academy has truly come from. It's something for the future, and yeah. So I think I will stop it there. There's lots of different value adds in this video. If you have any questions, drop them in the comments, like, subscribe, and I will see you in the next video. Goodbye.